Totally different. I'm just floating.
I haven't seen that specific one. I mean, I have seen that they've there's been proposals to have all contributions to retirement plans be Roths. So basically the government doesn't want to wait to get their money.
They want it now.
30, 40, 50 years, right? The politicians want it now. So, have you pay it up front and then give it to you tax-free over time. I don't know. That would be a dramatic realignment of the retirement map. I don't know if that's going to happen or not. It certainly could. I mean, the one thing I found is that typically, though, the government will, if you look back to the tax law changes that affected some of these things and insurance policies and whatnot, typically they grandfather in plans that are already there. So, for example, it used to be that certain types of cash value life insurance policies, before there was Roth IRAs and 401ks, people would use those as a supplemental retirement plan. And back in the 70s, they paid very high rates of interest, like 9-10% interest. Okay. And so people would plow a bunch of money in there, and you can take your contributions of insurance policy out and leave just your earnings in there. So they would let the earnings just in there and accumulate money, dividends or interest over time. And then when they died, there would be a tax-free benefit. So they basically put a bunch of money in there, pulled out 5 or 10 years later, and still have a policy earning tax deferred. And so in 1986, the government said, that's an abuse of tax shelter. You can't do that. But anybody who already had one of those policies was still allowed to be taxed as it was previous.
Okay.
So my guess would be is that if you contributed money so far to your 401k and they would make a law like that their grandfather the money you have in there, and it would just be future contributions. But that's strictly speculation.
Hey, we don't know.
That would be following precedent, but it is the government after all. So.
Right. I mean, another thing that comes into play is starting early.
Yeah, huge.
So you want to start early. Another statistic that I came across later in life, I wish I had found out about it earlier, is that year over year, the stock market goes up, stock market goes down, but the market in general goes up about between 8 and 10% on average.
Yeah, 2008 kind of messed with that a little bit just because of the large drop. But yeah, in general, the S&P 500 is going to return over any 30-year period, roughly 8 to 10%. That's pretty consistent. So, when you look at that...
And that's per year.
Yes, that's an average annual return.
Right.
Roughly. So you look at that and you say, gee, that's pretty good, right? But you got to have the discipline to put the money in there, just continue to invest, not moving in and out of the market at the wrong time. Because even though there was a study, and I can't recall it, but they did a thing over the previous 30-year period of the S&P 500 had returned roughly, it was like 9 or 10%, but the average investor had only returned 3.5%. Was because they bought high and they sold low.
Right. They get emotional.
And again, that's where if you have an advisor, they'll say, well, listen, you have 20 years until retirement. Just let it ride.
Right. Just let it go.
Yeah. We saw that in 2008 when people thought they were an aggressive investor or a moderately aggressive investor, and then they saw their assets go down, 30, 40, 50%. And, you had to hold their hand and say, just let it reappreciate. And in about 3.5 years later, they were up roughly to the point where it had started to go down. And at that point say, okay, this is how you felt in 2008, March 2008, when the market hit the bottom. Are you still really as aggressive as what you were before that? And a lot of them said, you know what? No, I'm not. I want to cut back on my risk. And particularly people 50 plus that are nearing that retirement age. So that is part of the equation in that. But, the average investor, if you just talk to somebody in a chat room on the internet or over the call center, they don't give you that advice. So, I'm probably a little biased that I think an advisor or planner adds some value.
Right.
But, you can't, you got to protect yourself from that emotional twist, because trust me, I saw the statements coming in 2008 and people losing 50%. And, it's hard to say, well, the market's down 60, we only lost you 50.
Big win.
Right. If we made 60 instead of only 50, on the way up, that, you look like heroes, that 10% difference. So
well, now you worked through the 2008 recession.
Yeah.
Any interesting stories, crazy stuff that happened during that time period, being in the financial sector?
I will tell you, there's a term we use, capitulation.
Okay.
So the two people who were always my most nervous investors, right? And who you had trouble protecting from themselves.
Oh, man.
When they called in and said, I just can't take it anymore, I need to sell everything, was right about the time the market bottomed. And everyone else at that point I had already talked to, and they're like, we know we're just going to ride it out. And so when they capitulated, it was right about the time March, in 2008, where the market started, or in 2009, where the market started to go back up. So it was really it's a shame for them, but we did see that. I had a lot of people who were saying, I don't know if it was necessarily the most advisable, but it worked for them. I'm not even opening my statement, right? A lot of people still got paper statements then, not emails, but I'm not even going to open it. I just put it in the shredder, or I just put it in the filing cabinet. I'm not even going to look at it until the market comes back up. The other thing, and a little bit of politics in this, is I still remember when they were talking in 2008 about the TARP vote, to basically put money into the banking system to keep it liquid, which was very controversial, and it was a bipartisan vote. And I still remember my coworkers and I watching C-SPAN on the computer, watching the vote, and we were watching where the numbers were going and everything, trying to see if that the first time through, if that vote was going to pass. And Republicans and Democrats and independents, if we're all there, we realize the importance of this. The common person, who doesn't understand how credit works, maybe not so much, but it failed, and then the market went down like 1,000 points after that vote failed. And we were all sitting there thinking, a week from now, are we even going to have a job? Like, is there even going to be an economy?
Oh my God.
And then of course they came back and they did pass it with some adjustments, and the money went into the credit system and got credit going again and everything. But it's like I was trying to tell but my father and I were talking that weekend, people don't understand, like, a car company can't loan you money to buy a car if they can't sell bonds to free up that money. That they collateralize those bonds to do that. You can't buy a TV on credit. Credit card. They sell bonds to back that money, and the banks were just hoarding cash, so they weren't loaning any money to anyone. And if credit dries up, commerce can't work.
No.
A store doesn't. A store will take out credit before Christmas time to load up on inventory, right?
If they can't take out any credit, how are they going to load up inventory? How is anybody going to buy anything?
Correct. Yeah, it was really something. So they were really dark days. I mean, that was really a tough time. I felt bad for a lot of people. A lot of people were really scared. I honestly was scared, but it's a country we pushed through it, and you've seen since the market bottom in March of 2009. I mean, basically the most unprecedented bull market in history. Basically going on 10 years now. It almost has created the opposite problem, where now a lot of our investors and our clients, they don't want to meet because they say, well, we don't need to meet. Everything's good. And I'm like, no. We still need to meet.
Let's talk about this.
So yeah, it's funny how human psychology is quickly to forget the bad times.
Yeah. Well, back in October, we had a little dip.
Yep.
And for me, now I have access to it on my phone.
Right.
So I was watching it every day and thinking, is this the end? Are we going to hit another recession? Are things going to dive down again? Thankfully, we pulled out of it. I know we're talking about tariffs again in the news today.
Yep.
So that's another dip.
The market doesn't like the unknown. I'm a big believer that, and I tell my clients this, that the market doesn't really care which party controls the White House or Congress or whatever it is. The market is almost fine with the stalemate of nothing happening, because that's predictable.
Right.
What the market doesn't like is the unknown. So where does that come from? Well, that can come politically within the country. That can come politically from outside the country. September 11th, for example, geopolitical event, or the terrorist strikes that sparked two wars. The market crashed, the day when they after opened the markets. I don't know if it was a day or 2 days or 3 or whatever it was after September 11th, but the market went down because people were scared. They were running for safety. So yeah, I mean, the market does not like the unknown. If you look at 2016, when everyone at least the smart money, so to speak, on Wall Street was pretty sure Hillary Clinton was going to win. And then it started to swing later in the night that looked like Donald Trump was going to win. The market was down, I don't know, 600 or 700 points in the futures market.
Right.
And if you looked, when I went to bed finally around 2:30 or so, when I got up at 7:30 and looked at it, it was only down about 200, and by the time it actually opened at 9:30, it was up and it rallied that day. So,
oh, great!
It was just, I don't necessarily think it was one personality or the other. It was just that everyone assumed something was going to happen. I mean, 90% of the population, and then the exact opposite happened, and that freaks out the market. So,
right.
It is. It's a bit of an issue, but it always seems to work out. So the market will go down again someday, right? It has to. I describe it like a bush or a shrub. It has to get cut back every once in a while, or it just gets unhealthily big, and you have to really cut it back really hard. And it's you don't want to do that. It's better to trim it back every once in a while and let it grow as a bigger, healthier bush or shrub over time than to sort of binge and purge on the growth and the cutbacks.
You get rid of the dead wood out of there.
Correct.
Let's step back to talking about people and starting out with an investing.
Yeah.
And one of the things that I've read to deal with emotions is to just invest.
Yep.
At a certain rate every week or every month, same value. I mean, a lot of this is automated through your 401k, but outside of that, the strategy that I'm talking about is dollar cost averaging.
Yep.
Do you want to speak a bit about that?
Yeah, big fan. So basically dollar cost averaging, be it in your 401k, or you could do it in your IRA or Roth IRA, or just in a taxable brokerage account, is, every month or every pay period, a certain amount of money comes out of your paycheck or comes out of your bank account and goes in. And some months you're buying at a little higher rate, some months you're buying at a little lower rate. But again, to part of our previous conversation, we know that the S&P 500, historically goes up roughly 8 to 10% over 30-year periods. So as long as you don't need that money in the next 3 to 5 years, it doesn't really matter. Just let it ride. I'm not telling you not to look at it, because that would probably be not the best advice, but look at it no more than once a quarter, maybe once a year, especially if you're younger. If you're 55 plus, it's maybe a little different at that point. Your priorities are a little different, or if it's money you want to spend on your kids' education and, they're in high school, that's a little different. But, if you're 20, 30, 40 years old and you're saving for retirement, look at it once a quarter, once a year, and just let that dollar cost averaging do its job. And historically, I don't have studies I can name, but it works out very, very good in your favor. I mean, even if the market corrects 10% and then you have money going there, the money you already have, those shares you already bought went down, but you just bought something that you already wanted at 10% discount.
Yeah.
I actually had a client, this is not dollar cost averaging, but he had some money in cash, and during the financial crisis, he actually threw an extra $10,000 into his kid's college fund near the low of the market. And I told him, I said, I can't guarantee it's not going to go any lower, but I know 5 years from now, I shouldn't say I know, but I felt pretty confident 5 years from now it'll be higher, and he was rewarded for that. So, again, that's the psychological thing. So dollar cost averaging into the market, I'm a big fan of. For those people who are near retirement, I'm not a fan of dollar cost averaging back out of the market.
Okay, why is that?
So you want to have a little bit more control when that money's coming out, because, if you have it, you don't want to sell something after it went down 10%. Buying something after it went down 10% is good. Selling it after it went down 10% is bad. So, if feasible, for my clients, I normally try and have anywhere from 1 to 5 years, depending on the interest rate, of cash in something safe that won't fluctuate. You may not get rich in there, but it's earning some interest, and let the rest of the money do its job. Let that earn there. But when you have good years, you sell some stuff and you replenish that cash account. When you have a bad year, you just let it ride out and reappreciate, so that you don't have to sell assets when they're down. Now, obviously, there's some circumstances, health issues or a job loss or something, that you can't always control that. But in general, you try to not dollar cost average out of the market, but you do dollar cost average into it.
Okay. All right. Good advice. Anthony, one of the other aspects of investing is risk. So could we talk a little bit about that?
Yeah. Risk is a really important thing. And part of risk is your time frame until you need the money, right? So if you need the money in 3 years, you don't want to put that in something that's going to fluctuate, because basically it's just a casino at that point. Because even though we know over most 10-year periods, S&P 500 will go up, aka the market, and over 30-year periods, it definitely does. We don't know in a 3-year time frame. All right, you look at 2000 through 2002, it went down every year, double digits. So you don't want to put money into the market that can fluctuate if you have a short time frame. So in that, I would say that you want to default to a very conservative, something interest bearing at that. And in this environment, 2% is considered good, and some people get a little irritated by that because you don't earn a whole lot. But that's an important thing. Now, if you have a longer time